Hey everyone! So today I just wanted to touch base with the oil tanker stocks craze that we've been having here on YouTube recently, and also briefly mention some companies that increased their dividends, as well as some companies that unfortunately cut their dividend as well. So it looks like the oil tanker craze was started by Jeremy. He really kickstarted this with his video on why he was buying the oil tanker stock NAT. And I usually follow the strategy of take whatever he's talking about and run the complete opposite direction. And I've noticed that that's actually worked out pretty well for me. And I can actually say the same about most of the people that talk on the show CNBC. But I love Jeremy and I love his energy and I watch all of his videos. Plus he was one of the first YouTubers who was always very bullish on Tesla, even when the sentiment was really poor on them. And he really gained a lot of money on that bullish sentiment that he had all the way back then. It's hard to remember that people used to hate Tesla and now everybody loves them. But me and him, we're just two very different investors. He seems to really love the seasonal retail companies that would perform kind of poorly in recessions, while I'm more of the low risk, low reward, get rich slowly kind of guy. Plus, he seems to have this really weird obsession with things that run on water.
Like there's this guy who invented this car. It runs on water, man. It's got a fiberglass air-cooled engine and it runs on water. Hey, did you guys hear about that car that runs on water? It's got a fiberglass air-cooled engine and it runs on water, man.
Oil tanker stocks are basically a ship designed for the bulk transportation or storage of oil. And don't be thinking of a high-end luxury boat like Carnival Cruise. These don't need to have anything that's all these bells and whistles that you would need on a normal cruise ship. And why would these be gaining traction at a time like this? Well, the C-19 situation set the demand for oil and natural gas hitting record lows. You have people traveling less, whether that's in cars or airplanes, but basically everyone, for the most part, does expect to one day return to normal. So oil will always probably be an integral part of our everyday lives, at least for the foreseeable future. And when you have that variance from what people will pay for oil right now versus what they'd expect to pay in a few months down the road, that's part of the reason why oil prices went negative. You have oil producers paying buyers to take the commodity off their hand. Now you might be thinking to yourself, if oil demand is low, why do oil producers keep pumping oil? Well, the answer to that is that oil can't just be flipped on and off like a light switch. A well that is shut down can be hard to turn back on. The CEO of EAG Services, an oil consulting company, compared it to a bottle of soda. Let's imagine it's one of the companies that we own, like a Pepsi Max or a Cherry Coke. Now, if you open that can of soda, if you open the cap and put it back in the fridge, it will never be as bubbly as when you first opened it. So if you stop pumping and then try to get it running again, there's a good chance that you will have to invest even more money to ever get the well to pump back at the same levels as before. Also, think about all the legal contracts that are signed before drilling even begins. Those don't just become void when the demand goes away. Okay, so for those reasons, where can oil now be stored if production can't be halted? That's where the oil tanker stocks come into play. The logic is all the excess oil can be stored on these ships for months until they are ready to be harvested. And you know what? I went ahead and followed this logic and I went ahead and bought 25 shares of DHT Holdings. Now, I follow more of a dividend growth investing strategy to buy stocks for the long term and just continue to hold them and reap the dividends. This stock, however, is not a long-term hold. This is more just me speculating that the stock price will rise in the short run and I can just make a quick profit here. It's already not looking too good for me here as more and more places are in talks of reopening to some degree. And that means that the demand for oil is going to go up, at least in the short run here. So DHT has these tankers called VLCCs, which literally stand for very large crude carriers. So they have the capacity to store up to 2 million barrels of oil, and they can demand as much as $350,000 a day. Not a month, up to $350,000 a day. DHT has 27 of these VLCCs in total. Now, they have been able to lock in some rates here for at least a year when the demand of their service is so high. It's so high that even if oil does recover, they will still be getting paid handsomely. About 22 of their ships still have room for new contracts, meaning that they can take full advantage of the demand that these prices have right now. Normally with most stocks, when you're researching them, you want to see if the revenues are growing. While DHT's revenues are growing, that's not too relevant for me because I'm really just pricing in these big gains in this upcoming year. I'm not buying based off anything that it's done for me in the past. In terms of its balance sheet, DHT has about $67 million in cash on hand, which is in line with what its competitor, the other hot stock, NAT, which has $61 million on hand. But it also has a ridiculous $750 million in long-term debt, which would usually be a big red flag if I was buying the stock for the long run. But my logic was maybe if the company gets more record profits this year, they should be able to pay down that debt more. Since DHT was formed in 2005, they have paid dividends every quarter except for 3 of them during the last recession. But this is not a stock that I would buy for the dividend play. Sure, if you looked it up, it would say that this stock is yielding about an 18% yield. But the dividend paid every quarter is extremely inconsistent. It doesn't seem to be following any rhyme or rhythm. Now, the reason why I bought DHT over NAT was that, well, for one, this was the lesser of the 2 cult stocks. So I'm hoping for a little less volatility there. I also like that DHT's operating margin was considerably better than NAT's, beating it 26 to 10. So that basically means out of every $100 that these oil taker companies spend on their business, NAT is actually only keeping 10 of those dollars. Plus, DHT has more ships, and it also those ships are also bigger, meaning that they can, in a perfect ideal world, they would be able to make more money since they're operating at full capacity and there's just more room, therefore more revenue. But again, that's just in a perfect situation. At the end of the day, this is really just speculating. That's why I said that this is more of a high risk, high reward opportunity. I will probably lock in some profits, hopefully when this thing goes back up over $10, I'm hoping. I also don't think that NAT is a bad stock either. I invest like a 70-year-old grandpa sometimes, so I think it's nice to just try a different approach, and I can sleep well at night knowing that most of my money is in great companies, and I wouldn't be too mad if I lost out on, $200. This makes up less than 1% of my portfolio. So make sure to let me know in the comments if you guys are buying these oil tanker stocks, as well as which one. Also, let me know if you aren't and what you're buying instead, and don't forget to hit that like button and subscribe to the channel. Unfortunately, we had a company cut its dividend this past week, and that was Shell. And it's not every day that news like this comes out, because the last time that Shell actually cut its dividend was during World War II. So that was just a little bit of time ago. Just a few decades, that's it. Actually, in my last video where I talked about Shell, I actually mentioned that they should be able to weather the storm, and I had that incredible statistic about their dividend record. Well, I'm sad to know that that was actually the last time now that I'll ever be able to share that. I'm not that surprised, really. I think all these other major oil companies, they will be cutting their dividend as well if the world continues to operate the way that it's doing, and if we can't contain the C-19. These companies are basically on life support, as Shell is going to be saving about $10 billion annually from this dividend cut. But let's try to end this video on a good note, and that is Apple raised its dividend by 6.5%, now pays 82 cents a share every quarter, which is up from 77 cents. And hey, every more penny that we can have in our pockets is fine with me. Apple is sitting on a huge pile of cash that is larger than many countries' entire GDP. It also has a very modest payout ratio. As you can see, it's $1 trillion market cap company. Overall, the company may struggle here in the short term, but long term, this is a great company that should only continue to benefit from the services that it provides. That includes Apple Music, Apple Pay, iCloud, Apple TV, plus all of their wearables that are becoming more and more popular, plus their marquee item, the iPhone. I'm very bullish on Apple. I will probably always be bullish on them. Let's just hope that they don't pull a Boeing with their massive share buyback program, and hope that doesn't come back to bite them. As always, guys, be sure to hit those buttons and know that none of this is financial advice. Always do your own research. This is just for educational purposes only.